Hi, today we're going to get started by reviewing our method of investing. And I have a lot of new people listening to this now, so it's pretty important to review kind of what my theories are, what's worked for me, and um, explain them in detail because what I show during the week is sometimes confusing if you don't have a background of my theories. Um, Here we go. First of all, my theory for investing is to buy and hold two types of stocks. One is permanent compounders. These are stocks that you can buy and hold, and they continue to grow about 10% or more every year. And the other type of stocks are dividend stocks. And these are stocks that continuously pay a dividend and they increase their dividend over time, usually. And that allows you to keep up with inflation. And so my strategy is to amass a huge amount of unrealized gains that you that your stocks grow in value over time, but you don't sell. And you want to generate enough with dividends to live on. And after you've amassed a huge amount of unrealized gains, if you want to sell them without consequences for paying capital gains, you can move to Puerto Rico for a year. And there, if you sell your stocks, there are no capital gains tax at this point in time. That's my plan, anyways. It might change by the time I end up moving to Puerto Rico. Anyway, other things I do are I dollar cost into positions over time, and I reinvest dividends. I buy more of a stock when it's out of favor and undervalued. I use a PEG ratio to determine whether a stock is overvalued or undervalued. If a PEG ratio is 1, it's fairly valued. If it's less than 1, it's undervalued. I sell a stock when the long-term prospects of a company goes down. Let's say some of the hardest things to figure out is if a competitive moat of a company will still exist 20 years from now. Um, and sometimes companies are disrupted by different technologies like AI, and you have to be willing to do the research and figure out, is this company still growing at 10% for the next 20 years? So that's tricky. We do that every week. We look at the news stories and we find out little tidbits of information that give us hints that the company is still going to be growing. Market time purchases when stocks are oversold and sell stocks when they're overbought if we're inclined to sell stocks. I like to buy and hold, but occasionally you want to lighten up on a position and you sell them whenever things are overbought. Um, Jim Cramer says to buy and homework. Buy and homework is once you buy a stock, you research on a regular basis that stock and to see if news affects the long-term prospects of a company. Um, in retirement account, I have some theories that I'll explain in a second. Consider converting some of your traditional IRA to Roth, especially when the stock market is like crashing, or contribute to a Roth instead of a traditional IRA. I can show you the differences in this session about how much that you'll make over time and how that works. So, first of all, I'm going to explain a little bit about timing the market. Okay, so whenever I have a chart, and let's look at the chart of the S&P right now. You can see that a stock can be either oversold or under. Let me see. Let me get the chart up here. A stock can or an index can be either oversold or overbought. So we have this indicator. It's called slow stochastics. And it's like a sine wave pattern. Whenever it's at the top right here above 90, that's an indication it's overbought. And whenever the stock or the index is around below 20, that's an indication it's oversold. Stocks and indexes usually follow a pattern that what I do is I draw a line at the bottom of the chart and the top of the chart. That's called the channel that, and usually stocks go up and down between that channel. And I like to buy when it's at the bottom of a channel and sell or don't buy whenever it's at the top of the channel. And hopefully that's going to align when a stock is overbought. When it's overbought, you sell. And you can see whenever it's oversold under 20 in the stochastics, that's a good time to buy. But if a stock or index goes out of this range and it starts growing down here, um, that's the time where you don't want it. It's failing its chart pattern, so we can't use this after that happens. So I'll give you some examples. Let's look at some current stocks. Like right now, we can see the XLU. This is the utility sector. It was in an uptrend for quite a while, and right here, it kind of broke out of that uptrend, and it's starting a downtrend. Whenever stocks are in or indexes are in downtrend, I don't usually like to buy or look at them. And I like to wait for it to go into an uptrend to buy them. So let's look at the next section. Review what makes a good growth stock for a buy and hold. Um, okay, so I have some formulas here. This is primarily stock formulas that Warren Buffett, a lot of value investors use for investing, for buying stocks. You can see that um, I look at earnings estimates going out a couple years. You can see that a permanent compounder usually has very consistent earnings in an uptrend. You can see that there are some quarters that where a company makes less money than other quarters. And that's because let's say Apple makes more money in the fourth quarter because everyone buys their iPhones for Christmas. So they would have a bigger fourth quarter every year. And you can see that every fourth quarter is higher and higher. And maybe the second quarter isn't they don't make as much money. But in general, good quality growth companies have a continuous uptrend in their earnings estimates and their past earnings. Warren Buffett usually doesn't like buying stocks unless they have a history of good earnings in maybe 5 or 10 years of good earnings before he looks at a company. I like to look at the next couple years, and the way to determine a growth rate of earnings is you divide 1 year, like this year, divided by this year, that gives you that growth percent. And this year divided by this year, that's the growth percent for that year. And I like to see a growth rate. Let me see, hold on. I like to see a growth rate of over 12%. And I like to see a profit margin of over 12%, return on equity over 12%. And you have to look at the debt also. If the debt of a company is too high, then you might have problems. In the PEG ratio, we try to buy a PEG we like to buy stocks with a PEG ratio of less than or equal to 1. And that's basically the credentials. What I like to do is I like to do a stock screen every week. And the stock screens, they usually help you determine if there's any stocks that have been maybe gone down recently that are bargains. I'll show you an example of a stock screen. Wait, hold on. Okay, here's an example of a stock screen. You can see the peg ratio is listed in the stock screen, and that what I did is a screen here of undervalued stocks that are selling for less than a peg ratio of 1. And sometimes stocks have every stock has problems. Not every stock has some major issues, but the stocks that are trading for a discount usually have way more warts than other stocks. So you have to, part of investing is you have to look and see if those stocks are down for a reason, a good reason, or maybe they're throwing the baby out with the bathwater. So that's why I do a stock screen every week. Okay, let's look at um, the next slide here. You can see that with this comment from Brian Ferrodi that there's more money made in bull markets than is lost in bear markets. So the stock market is opposite the casinos. In the casinos, the longer you spend gambling, the better chance of you losing all of your money. But in the stock market, the longer that you buy and hold quality stocks, the better chances of you making money. So it's the odds are actually in your favor in the stock market. So let's look at, okay, that's okay. So that's basically a little background for what's to come. All right, so let's look at the calendar. The calendar, what we do is we mark out some major parts of the investing year. We usually, um, four, four times a year, companies report their earnings, and that's called the reporting season. And right now, we just had a bunch of banks report. And right now, we had Wells Fargo, a lot of these companies. We're going to have the tech stocks come out in 2 weeks. And usually that makes the stocks go up. So one of the theories that I have for um, investing is sometimes stocks go up at different times of the year and go down at other times, and that's called seasonality. And the interesting thing about seasonality, sometimes it works, sometimes it doesn't, but the law of averages, um, it's good to prepare yourself mentally for a down month. Like right now, January is turning out to be pretty good. It's usually up 1%. And February usually is not a very good month. And the months that are usually not very good are months that don't have earnings coming out. And a lot of times when you have a lack of volume and a lack of interest, um, you have stocks that are going down or not going up. And that happens when people are on vacation during the summer and whenever people are kind of waiting for spring in February. There's also the theory that in the Northeast, in New York City, when the weather is bad, people are not feeling good, so they don't buy stocks as much, and the prices don't go up as much because of that. Those are all theories, but we'll never know if that's true. Interesting thing about January is Strategists did a study going back to 1950. If January is positive, the rest of the quarter is up 1.6%. The first half of the year is up 5.5%, and the rest of the year is up 12.2%. But if January is negative, the first half of the year is minus 0.7%, and the rest of the year is 2.1%. So um, seasonality doesn't work all the time, but it's a good way to if you're dollar costing into the market, it's a good idea to um, expect, maybe a downturn in the stock market towards August, September, so that you can buy a little more there instead of when the stocks are going up. The other thing is the VIX also has a pattern of seasonality. VIX is the volatility index. So volatility is stocks going up and down in a major way. So if a stock goes up or the stock market goes up and down 1%, that's a high volatility. Whereas if a stock market goes up 0.5%, then down 0.3%, that's a very low volatility. But in October and towards November, that is the highest volatility of the year. So you have to, part of investing is being able to um, kind of predict what's going to happen next so that you're ready mentally for a stock market to go down or up. All right. So let's look at some examples here of stochastics. Stochastics are, you can go to Yahoo Finance and you can add some criteria to your charting patterns to give you a slow stochastics. And right now you can see we've been overbought for a couple months. So, and you can see that we're right in the middle of our channel and we're not, this right here is at a buy time because it's at the bottom of the channel and it's oversold. Right now we're kind of high for the last 2 months, basically. So it's we're in the middle of nowhere land right now. It's not a buy signal, it's not a sell signal, but it's definitely overbought. And part of my theory is if it's overbought, it's not really a time to pile in and buy stocks at this time. 90% of the stocks in the stock market follow the S&P 500 chart wise. So that's why at the beginning of every one of my talks, I look at the S&P because as the S&P goes, so does 90% of stocks in the stock market. And right now, there's no clear indication of where we're going to go next. So we can't get any hints there right now. The U.S. Treasury is very important because the U.S. Treasury is one of the safest investments in the world because it's always been an investment that investors go to for, say, as safety. Whenever there's a crisis in the world or if there's a crisis in America, um, the yield for this goes down because there's a high demand. So whenever there's a low demand for treasuries, the yield goes up. And everything is measured against the 10-year treasury. So whenever you're investing in the stock market, you get an average of 8% return, but you take a risk whenever you invest in stocks. If you were guaranteed an 8% return in treasuries, there would be a less demand for stocks because people get a guaranteed 8% return in the US Treasury when they have to take a risk when buying stocks. What we're looking at right here is the S&P index compared to the yield of the 10-year. And usually there's an inverse correlation because as the yield for the 10-year goes down, people are in need of yield, so they would have to put their money into stocks to get a better return. But as the yield for the US Treasury goes up, the demand for stocks goes down. So far there's been an inverse correlation in the last last 2 weeks or the last 2 months or so, we've been going sideways in the yield. And we're kind of sideways in the S&P 500 also, if you look at it from here to here. So that's why it's important to keep track of the U.S. Treasury yield. Okay, so other factors that are in that we keep track of are the price of oil. The reason why the price of oil is so important is it gives you a hint of the global economy, whether it's slowing down or whether it's accelerating. And right now we have a very low price of oil, which is like $59 a barrel. A lot of times that's an indication that the world economies are either slowing or they're increasing their production around the world. As the price of oil goes up, oil is the main number one input cost for most companies because you have to transport your goods after you make them, and that requires oil. You need oil for powering factories, and as the price of oil goes up, then that has an effect on the profitability of companies. That's why we keep track of this price of oil. Right now, it's down pretty low, and that's good for companies. Um, Inflation we keep track of. Right now, it's pretty low at 2.68%. And inflation's important as an in investing as an investor because as inflation goes up, the purchasing power of your dollar goes down usually. So, so maybe in 10 years with high inflation, it'll cost you $20 to buy a banana. And because of that, you have to invest in a different way so that you can grow your money faster than inflation. So right now, inflation has been staying pretty low in America because the Fed has been pretty good at keeping prices stable. Um, the US dollar index is pretty important also to keep track of. The DXY is a index that compares the United States dollar to other currencies. And it went down last year, and that helped multinational companies and foreign countries because a lot of things are priced in the dollar. And if the price and as the more whenever stocks in the United States repatriate money into the United States, if they have half their sales in foreign countries and the US dollar is going down, they're going to benefit from the US dollar going down. So I guess as an investor, we're kind of rooting for the US dollar to depreciate because that helps corporations. But if you're buying bananas at home, that doesn't help. But in general, a DXY that goes down helps all the countries, I mean, the companies doing business overseas. Okay, so according to Morgan Stanley, every move up and down 10% in the US dollar equals 3% hit to US earnings. So if the US dollar, this DXY index goes down 10% in a year, the companies in the United States will be 3% more profitable. It's it's also works the other way around. We also keep track of gold because right now gold is a way it seems to is a hedge against inflation. So if there is inflation and if there is global uncertainty and turmoil, people gravitate towards gold. Gold really, Warren Buffett doesn't like gold because it doesn't have a yield. It doesn't produce earnings. Um, so it doesn't match with Warren Buffett's methodology. But there are a lot of people that buy it because it's actually been one of the best investments over the past 50 years if you track it against the S&P 500. Um, so you have to be either a believer in gold. Gold has a couple different values. One is central banks around the world are using it as a um, form of stability. The central banks used to use the US dollar, but now they're moving away from that. So there's a lot of demand from foreign um, central banks. Also, there's industrial, very small industrial usage, and we also have gold used for jewelry and things like that. But silver is actually a little different. Silver does have a industrial use. So there are people that invest in gold and silver as just an investment that could it could be a way to diversify your portfolio over if you're concerned about global uncertainty. All right, so let's look at okay, this is the US dollar index. From last year, you can see from let's say May of last year until now, like almost 3/4 of a year, we've been going sideways with the dollar. So that has basically a neutral effect on US corporations. If we see it going down to maybe 10%, then we know that 3%, the earnings of the S&P 500 might be greater by 3%. Let's look at the fear greed index. Okay, so Warren Buffett once said, be fearful when others are greedy and greedy when others are fearful. So what we try to do is we try to do the opposite of everyone else. Whenever people are fearful, extreme fear, we start looking for things to buy. When people are greedy and have extreme greed, we either sell or don't buy. So we do the opposite. Warren Buffett once said, when there's gold coming down from the sky, um, don't bring a thimble, bring a bucket. And so we like to follow Warren Buffett and what he does. And that's why we follow the Fear and Greed Index every week. And we also look at the AAII survey. This is the American Association of Individual Investors survey. So we like to look at the opposite side of things too. Everyone is bullish right now in the amateur investor survey. So our translation is caution, take some profits off the table or don't buy. So we do have right now a greedy feel in the stock market. Okay, so right now the VIX is something we also look at. The VIX is a fear gauge. It is basically a calculation that uses options and other different methodologies to determine how fearful or how greedy the market is. When the VIX is pretty low, like 10 to 20, that is an indication that people are not afraid and they're not buying protection. They are risk on. And whenever the VIX gets up to 30 or 50, that is a panic. And people are basically whenever the stock market like goes down or if there's some uncertainty, then or a major event, people try to buy protection at that time. And that's actually the worst time to buy protection because it gets very expensive. But that is the time when Warren Buffett starts looking for stocks to buy. Right now we're at 15, which is really low. And it's just an indication that right now the stock market has a lot of momentum. And you can see that whenever we're looking at the S&P, let's look at the S&P. Right now we have momentum. We have over 70% of the S&P above the 200-day moving average. So let's look at the moving averages. We have a couple moving averages that we follow. We have the 20-day exponential moving average. That's this yellow one here. And that is a good indication that we're in an uptrend. And a lot of market followers look at that and to see if we're going to continue in an uptrend for a stock. And you can see that this is the 50-day moving average, the purple line. This is a 50-day moving average is a combination of the prices of the end of the day of every day for the last 50 days. And whenever it's in an uptrend like this, when these moving averages are in an uptrend, that's a sign of momentum. And a lot of chart technicians have a tendency to be afraid whenever the actual chart, the stock chart goes below any of these moving averages, that's an indication we've stopped this uptrend, which is indicated by these channels, and we're starting a trend to go down. Let's look at it. Let me see. Let's look at a chart that's going down, just to give you a little idea of that. Okay, so these stocks, right, like this stock, right? This is Colgate Palmolive. You can see that this is in a downtrend, and whenever a stock has a established downtrend, it's not fun. Usually, you have lower highs, you have lower lows until you break out, until you have something like this where you break out of it. So we don't like to touch a stock that's in an established downtrend because usually lower prices and lower highs and lower lows yield lower prices over time. But we do look for quality stocks that are in downtrends that actually break out of downtrends. And you can see this one could be developing a new uptrend. This happened this year with the XLE sector. Let's look at the XLE. This is the energy sector. The energy sector was in a downtrend for like 3 years. And this is the downtrend right here. And at this point in time, we broke out of that downtrend. Let's look at an example. I'm pulling this up. XLE. I'm pulling up a chart of the XLE going back 5 years. Hold on. Okay, um, you can see that this chart actually is in like a sideways pattern for like multiple years. And we were basically in a downtrend. You can see this right here going back from 2014. And right here, we broke that downtrend and now we're starting an uptrend. So part of what I do in investing is I have small amounts to invest, every now and then. Um, I like to buy stocks for a long term buy and hold, but sometimes it's good to time when you buy it, and when you dollar cost in the stocks. So, all right, that was a good excursion. Another thing I go through every week is the emotional graph of the typical investor. And the important thing about looking at this emotional chart is you have to be in control of your emotions when you're investing. So right now we're in a greed phase in the stock market, and we have people on TV excited, and we have a lot of enthusiasm. Um, it's at that time that you kind of do the opposite of what everyone else is doing. You kind of don't buy and don't get sucked into what they say on TV. Whenever there's despair and capitulation and people are fearful, as Warren Buffett would say, that's when you start getting out the bucket to collect the gold particles, not the thimble. And so right now we have greed in the stock market. So you have to basically sit around and wait for an opportunity. Warren Buffett once said, in the stock market, you have an unlimited amount of pitches. You can wait for your pitch. And whenever he's comparing against baseball. So in baseball, you usually have three strikes and you're out. But in investing, you have an unlimited amount of pitches that come to you, and you can wait for your time to buy. And I like to buy stocks whenever they're on sale and whenever no one else is interested in them. Um, okay, let's look at, okay, so another thing to think about when investing is you want to have a diversified portfolio because different sectors go up. Um, a sector that might work well this year might not do well next year. And this is called an asset quilt. It basically tells you, the performance of different sectors every year going back, 10 years or so. This is actually for 1 year. You can see that just in 1 year, you have a various amount of performance for different sectors. So whenever you're investing, you want to try to be diversified and have a little bit of every sector so that you're diversified. And so whenever one sector goes up, another sector could bail you out for the year. Um, here's a here's an asset quilt over a couple of years, going back like maybe 15 years. You can see that this gray diversified portfolio, you can see that how it performs over time, it actually it does pretty good. It goes up like maybe 13% over time. Whereas if you invested in the same commodity index, you might have a worse performance because you don't have that diversification. So that's another thing to keep in mind. Um, okay, so also what I do every week is I compare the first to worst. Like last year, we had communication services, IT, industrials as the best sectors of the year. And a lot of times, some of the worst sectors from last year turned out to be the best sectors from this year. So that's why it's important at the end of every year or during the year to consider some of the sectors that are out underperforming. So last year we had energy as one of the worst performing sectors, and the year before energy was the worst. So we have a sector that's been underperforming for years, and this year, just look, it actually is one of the better sectors. No, what is it? This year it's up 6.7%. Last year it was only up 4% total for the whole year. Um, so and materials is up 7.2%, where when last year it was one of the worst sectors. It's only up 10%. So it's important to think contrary when you're investing. And okay. And sometimes this website here, this isabel.net, this tells you how overvalued or undervalued certain sectors are. And right now you can see financials are some of the um, worst performing sectors, compared to history. So that they don't, people are not paying as much for financials now as they have for the past 30 years. And the same with real estate and energy. So these are good tips to maybe find some stocks that could be in these sectors that could be part of your long-term portfolio. All right, so what we're going to do today, we're going to look at some financials because it seems like an undervalued sector that has been really hit in the last week or two. And it's been compared to history in absolute PE, the percentile ranks in history. It is one of the lowest valuations compared to history. So it's a good time to look at that. Um, okay. Let's look at the sectors going up and down today. Um, hold on, it'll be worth it. Okay, chain's going up. Okay. All right. So the important thing about looking at the market movers, the stocks going up and down the most. Sometimes you get ideas of themes, and a lot of times themes are what a lot of times stocks move up in themes. Right now, we have a theme of AI infrastructure. How do I know that? We have Supermicro. They are a company that makes hardware for AI data centers. We have Micron. They make memory for AI data centers, high bandwidth memory. We have GE Vernova. They make turbines that power the power grid that help the AI data centers. Um, we have Quanta Services. A lot of these companies are companies that make the utilities that power the AI data centers. Um, we have PNC Bank, Synchrony Financial. Okay, so we have some theory. Our theme today is we have banks going up, and PPL. We have utilities. PPL is a utility. We have Quanta companies, GE Vernova. They make the data centers. Eaton is also a company that does data center grid development. So that's the theme there. The top decliners, a lot of these are high-flying companies that did good last year, and now they're giving back some. Constellation Energy, they were a big AI player last year. They make energy that's used by AI data centers. Vistra is the company that makes AI data centers. So we have some it's like the best of both worlds. We have AI data centers going down a lot and up a lot. I'm not sure what the news is about that. Um, okay, so we know that AI infrastructure and AI in general has been a hot topic last year and this year. So in our screens, we want to look for AI to see if there's any undervalued stocks that we could look at. Um, so let's look at the sectors going up and down today. We have real estate going up 1.3%. Part of our theories in the here, right here, the real estate sector was down the most last year. So a lot of times the worst performing sector from the past year could be a better performer this year. And look at that, the real estate is doing good right now. Real estate and stocks related to building housing, they're highly correlated to the interest rates. That's another. So and the price, a lot of the oil and energy stocks are correlated to the price of gold. So a lot of times different sectors are at the mercy, even if you have the best run mining company or the best run oil company, if the price of the commodity that you're mining or that you're drilling out of the ground goes down, your stock is going to go down with it. That's why it's kind of, um, I don't put a whole lot of money into commodity or stocks that are um, revolving around commodities because sometimes your stock that you own is not in its own, they cannot control their own future. All right, so let's look at the sectors going down the most right now. Home construction, that's interesting. Real estate is the best performing and home construction is the worst. Healthcare, home builders. Okay, so usually the sectors going up and down have a lot to do with the 10-year. So if we look at the 10-year yield, right now we don't get a good, it went up 6.6%, and that's a lot. So we have a formula for computing. Okay, if the yields for the 10-year are going up, That's positive for large cap stocks, financial stocks. Basically, if the yields go up, it's going to be harder for companies to afford to borrow money and to grow. And it's negative for, so that's why it's negative for any company that's borrowing money, such as companies that are not profitable. Um, okay, so companies that are high yielding, because if there is a high yield for available for a US Treasury, people are not going to take a risk for buying dividend stocks. So let's look at see if that matches our the US Treasury going up. So if the US Treasury goes up, we're expecting it's positive for large cap financial insurers. It's negative for small cap, high yielding home builders and REITs. Let's see if that happened. So sector ETFs. So this worked out just as we thought because home construction is highly correlated to interest rates. As the price of the yield goes up, it's going to be harder for people to buy houses because they're going to have to pay more for mortgages. Same thing with the healthcare. Healthcare, as the yield for the 10-year goes up, the healthcare pays dividends. So dividend paying stocks are less in demand if you have a guaranteed return for the 10-year. We have the home builders that follows the same thing as home construction. Regional banking, let me see, materials. Okay, utilities. Utilities, they have a tendency to pay a high dividend. So as the 10-year yield goes up, as this yield goes up, we can see that lesser demand for high yielding investments like utilities. Let's see if that matches our stocks going up. Real estate index, semiconductor ETFs. So I guess we can say that a lot of the semiconductor ETFs or the semiconductor companies don't need to borrow money. So they won't be as affected. We have gold miners, that's the price of gold. And we have, it has nothing to do with interest rates. And the industrial selector, let me see, why would this go up? Hmm, energy ETF. Okay, this is all, these are all at the mercy of the price of the underlying commodity. So gold miners, the same thing. Okay, so that was a good exercise, but you can see how important the 10-year yield is to major sectors going up and down because it has, as an investor, this is always an alternative to get um, uh, for an investment, for a yield, for a return, total return of a portfolio. So that is important. Let's look at the next slide here. I like to keep track of Dan Niles. He is like a really good fund manager, and he has his own hedge fund. He picks stocks at the beginning of the year, and a lot of times it's nice to follow along with his picks and to see if they have any credence. His best picks this year are Cisco, Boeing, Nike, and Apple and PI. This is Impinj. So far, his Boeing is up 10% this year, and Nike is break even. We have Cisco up now minus 0.8. Impinj and Apple are both down. All of his picks were down last year at the beginning of the year, and Cisco ended up going up 32%, and KWeb was up 32%, KBWB, which is the large bank ETF. So Dan Niles is really good. It takes a while for his picks to actually have some um, traction, but I like to follow what he's what he recommends at the beginning of the year. Okay, so every week I come up with different stocks and charts that are interesting, that have that combination that I mentioned earlier this week of being at the bottom part of the channel, this black lines that I drew in, and oversold. You can see that all the banks took a big hit last week because of earnings. There was also a story where Trump threatened a 10% cap on the credit card fees. And because of that, most of the banks took a hit. Whenever I hear news stories like that, you don't know if that 10% is going to happen. And it could be a good time to start dollar costing into some positions. But I already own JP Morgan, but if you haven't owned it yet, this would be like a good time to dollar cost into it. For instance, you can see it's oversold at the bottom of its channel, and um, it's out of favor right now. In MasterCard, you can see in this chart, it's oversold, and it was oversold probably with that credit card news. MasterCard is a toll collector. It has nothing to do with a 10% cap on fees. So it may be one of the babies thrown out with the bathwater. All credit card companies took like a 10% or 5 or 10% hit on that news. Let's look at the next chart here. We have Eli Lilly. You can see that it is in an uptrend here. You can see it's at the bottom end of its channel and it's oversold. And this one is Costco. You can see that Costco has been in a downtrend for quite a while. And it just broke out of this downtrend with a good earnings report. The interesting thing about Costco is it's it's like 2 times or more overvalued, but it consistently trades over the past 20 years at a high valuation. It's not the kind of stock that I would tend to buy because I like to buy things undervalued, but it has a very high PE ratio. But this is an example of a stock in a downtrend. I don't buy stocks when they're going down like that, but when it breaks out of that downtrend, um, it forms a new channel, and you might be able to buy it, whenever um, it starts forming this uptrend. But I like to, if this happened to a stock that I'm interested in, then I'd look at the fundamentals to see, does it have a solid 20-year time frame for continuing to go up? So let's look at the next chart. This is Capital One. This is an example of um, another stock that's a credit card company. They actually have subprime customers that need to borrow money to pay for things, and they rack up credit card debt. And they were hit more than most other companies. I thought it'd be interesting that you can see that they're oversold towards the bottom of their trading channel. So I thought it'd be interesting to go over this as an example of how to research a stock, that we've been following that goes out of favor and goes to an oversold state. Um, okay, we'll research that one a little bit later. This is an example of a stock screen. I do my stock screens at Fidelity. Everyone, I like the screen for like everything in the chart that I showed you earlier. Let's look at that chart pattern one more time, just for kicks. We have total return, a return on equity of greater than 12. We have profit margin greater than 12. A market cap over 50 billion because the larger companies are a little bit more reliable. We have a forward PE. We like to have a low compared to the growth rate. Um, a quality companies usually trade at a higher PE, and Warren Buffett has most recently bought companies with a higher PE ratio because they have a higher quality. We like to have a growth rate over 10 and a PEG ratio less than or equal to 1. And we like to have a chart that looks like this over time. earnings going up in a straight line compared to this stock chart. This stock chart right here, it is a one of Peter Lynch's favorite charts because it lists a stock chart to the actual earnings projections. And the way Peter Lynch achieved a great success at Magellan is he liked to buy stocks whenever the stock earnings projections are going up and the chart actually was going down. And um, he liked it whenever this, that chart combination. So I like to look for that same thing. And a lot of times when I'm doing my research, we'll come across that. All right, let's go back to our talking points here. Where were we here? Get back into this. Okay, so we're looking at some of our screens for this week. We've been looking at Micron for the past couple months, and it's still a PEG ratio of 0.41. So that's like almost half undervalued. We have American Express. We know that financials are out of value, out of favor right now. And we see a lot of financials, Wells Fargo, a lot of financials in our screen right now. And it's whenever the sector is out of favor and we have a lot of the credit card companies, et cetera, are in our screen, that's when I start doing some advanced research on some of the stocks in our screener. So I thought it'd be interesting to go through and look at American Express and Capital One, two stocks that went down like 10% this week. Okay, let's look at American Express. You can see that their chart pattern is almost perfect. You can see it's at the bottom end of its trading range and it's oversold. So it's like a perfect time to start buying if you were going to dollar cost into that stock. And we had the news about the credit card fees this week, and it doesn't affect American Express as much as it does a subprime lender like Capital One. American Express has very high-end customers that actually maybe pay a certain amount per year to use the card, but they get like all these rewards and they have a totally different customer base. So they shouldn't have been really published and punished with that 10% credit card cap news. So we'll keep that in mind. They might have been a baby thrown out with the bathwater. An important thing to remember about American Express is they are one of Warren Buffett's favorite stocks. Warren Buffett has owned American Express since 1960s. And so if Warren Buffett has blessed a stock, it has a certain acceptance in the stock market and it won't like disintegrate because it has the backing of Warren Buffett. Um, let's look at some of the news that made these credit card companies go down like 10, 20% this past week or two. Trump pushes a 1-year 10% cap on credit card interest rates. Okay, so even if that did happen, it's only for a year and it doesn't affect MasterCard, Visa, companies that are toll collectors. The companies that are taking a hit on this 10% cap are companies like Capital One, maybe some of the banks, maybe Bank of America or JP Morgan. So JP Morgan said they're going to fight that if that ever happens. So these companies like the banks are not going to take that. It's going to have to take a act of Congress to have a 10% cap on credit card interest rates. And most of Congress have donations by the banks. So there's no way they're going to allow that to go through, it seems. Um, Even if it did go through, it's only for a year. And that's enough to get a lot of what this story means. Trump is trying to get some votes for the midterms. And once the midterms go happen, then all these news stories will go away. Um, but it doesn't affect the long-term prosperity of American Express because they have a high-end consumer. Let's look at American Express and how I look at the earnings projections. I have some websites I go to. Let's look at one of the websites I go to for estimates. This is Market Watch. We're looking at American Express here. Let's see, AXP. Okay, you can see that we have these estimates. They go out a couple years, high, low, average. So we look at the average and we divide the years to get the actual growth rates. So in this case, we're looking for 26 to 27. If we divide 20.42 by 17.53, we get the growth rate of that company. So in this case, that's 12%. So American Express has been growing at around 10 to 12% for the last 10, 15, 20 years. That's an example of a permanent compounder. So if they're growing at 12%, and right now their PE ratio is 20, the PEG ratio is 1.7. That means they're 1.7 times overvalued. But all of the credit card companies are trading at a high valuation. So the motto I have is you pay more for a car that starts in the morning. So you pay more for a company that continuously grows at 10, 12% over time. We have a profit margin for American Express at 16%. That matches our 13% minimum. And return on equity is 33. That's like 3 times better than we're looking for. So almost all of the credit card processing companies have a high return on equity, which is what I like. I'm pretty heavily invested in credit card companies because they have a um, pretty asset-light business model. They have maybe credit computers to do the transactions. They have customer service representatives, and they take a certain amount of risk when lending to certain people. So that's their business model. It's pretty simple, and almost every credit card company has that same business model. So let's look at, and I also, whenever I research, I look at CFRA and I look at Morningstar for their ideas on the stock. And a lot of times they have a buy and they have a fair value estimate. That gives you an idea of how undervalued or overvalued a stock is at any point in time. And they also have buy rating too. If they have a sell rating, we want to stay away from it usually. Um, but right now, American Express has a buy rating, and CFRA has this little area, investment rationale and risk. And I like to read this to give me an overview of what the potentials of that stock is. They say our 4-star buy rating reflects their positioning to weather economic pressures given high-end consumers are less likely to default or cut spending. AXP's spend-centric model limits downside with just 20 to 25% revenue exposed to credit risk versus peers at 80%. Long-term drivers remain attractive with 3 million new cards acquired quarterly. International expansion offers compelling growth with 50% card spend growth over 3 years from a modest 6% share in top markets. That is an example of an investment theme and why you would buy the stock and continue to hold it. So what we learned from that is American Express has a high-end consumer. They're not going to they're going to spend a lot, number one. They're a toll collector, so the more that their customers spend, the better. Also, they're not going to default as much as other credit card companies because their high-end consumers aren't going to be declaring bankruptcy. Okay, um, so we have this section of CFRA's fair value calculation. I love this because it tells you what the fair value in their estimates are. I like to double check with my own numbers and make sure that it makes sense. And if you have both the fair value and your calculation matching up, that's a good double check before I buy a stock. Right now it says it's overvalued by 4%. Um, and we were looking at it, we thought it was overvalued by 1.7% in our calculations. We have, and Yahoo Finance has a peg ratio of 1.8. So Yahoo Finance thinks it's 1.8 times overvalued. So they think it's slightly overvalued, which is kind of a good indication that if you bought it today, then you got it near a fair value price. Earnings, we like to look at this earnings part of a report to see how the company grows over time and how consistent their earnings are. You can see that we had a small glitch here in 2020, 2021. Um, we always look at that pandemic time as a once that doesn't really count because every corporation had a problem then. But we like to see companies that are growing like 10% over a year, their earnings. And you can see that in the past 5 years, you've had that 10% earnings growth, but it hasn't been that consistent. It's a little bit $5 per earnings here, 3, 7, 3. But I do like this sector, so we have to look at their forward earnings and see, if they're going to continue growing. But you can see that it looks like they're growing at 12% right now. So that's pretty good. And it has Warren Buffett's blessing. Let's look at what Morningstar says about it. They have a price to fair value of 1.727. So they think it's 1.27 times overvalued right now. Um, on their top thing that they're concerned about is the 1-year cap on credit card interest rates to 10%. If that happens, they say the cap will be unlikely to be implemented, but if enacted, it would have dire consequences for credit card profitability. So anything is possible. So the stock's going down 10, 20% in the last 2 weeks. Um, it has a possibility in this world of Donald Trump. So we have to be ready for that. And uh, for my investing, right now, American Express is trading a little bit overvalued. If we did have this enacted and we do have a really bad news story, that would hurt the credit card profitability for a year, if it was for a year. Um, but that would be a good time to jump into stock when it had a fair value of less than it is now. So that's kind of my mentality for news stories and how to research, how to get some research reports to think through an example of this draconic story about 10% credit card cap fees. A lot of these credit card companies charge 15 to 20% credit annual charges for borrowing money. If this if this actually went through, then people would end up going to the 20% pawn shops to borrow money, and that would be worse for their constituents. So we'll see what happens there. Um, let's look at another stock here, Capital One. It'd be interesting to right now it has that similar pattern where it's oversold at the bottom of its trend line, and um, I'd like to look at their valuation right now too. Right now, the growth rate of Capital One from this year to next year is 30%. So they're growing their earnings at 30%. Their forward PE is 11. So that means their PEG ratio is 31. Let's do that calculation right now, just for fun. Okay, 31 divided by 11. No, 11 divided by 31. It's 0.35. That means it's 1/3 the price it should be. If it is truly growing at 30% and its PE is only 11, forward PE is only 11, that means it's 1/3 the price of that it should be. Its profit margin isn't that great. It's like half of what we're looking for. So that doesn't match what we're looking for. Return on equity is only 1.61. That is 1/7 what we're looking for. So what I do when I'm looking at this stock is I compare it against the other credit card processors. Um, so what we're going to look at right now is MasterCard's statistics. You can see that it has a valuation of 1.7 times what it's really worth. So it's an example of a car that you pay more for when that starts in the morning. It has a PE of 28, but it's growing around 15% continuously year over year. Its profit margin is 45 and its return on equity is 184. So this is an example of the profit margins you get when you have your own network. Visas are very similar. That's why when I see this profit margin of 4.9, they own this Discover network now. So I think this profit margin and return on equity is going to go up as they have synergies with the Discover acquisition. So this is an um, example of a stock that to me is 1/3 off right now and could grow their profit margin and return on equity. And we're going to look at these two things over time to see if that actually happens. And all right, that is okay. Let's look at what CFRA says about Capital One. They have a buy recommendation and a higher target than where it is now. They say our 4-star buy opinion reflects COF's Discover acquisition as an exciting long-term growth driver. Networks are difficult to build organically, and COF could benefit from expense and revenue synergies. The Discover network should help Capital One venture vertical integration economies and generate significant revenue without credit risk. Combined with their push into wealthier cohorts, this should drive stock re-rating higher. The $16 billion share repurchase program should reduce shares by 12% over 2 years. Okay, that is the investing theme. All right, so let's look at CFRA's fair value calculation. They say they're overvalued by 12%. So that totally doesn't match my undervalued estimation. So we got to be really cautious with this. Um, we have to check back maybe in a couple of weeks to see if that changes. The earnings, let's look at the earnings. It's pretty inconsistent. It's not up in a straight line. So we have a couple inconsistencies here. They think the fair value is less than what it's trading at right now. And okay, so all right. So the other thing I like to do when I'm researching stocks is look at what every quarter, every 4 times a year, mutual fund companies, hedge funds, large managers of money over 100 million have to report their top holdings. And I like to review the largest mutual funds. This is actually one of the largest mutual funds in America right now. So I like to review their top holdings over time to see if they've changed their holdings. And you can see that they have some of the stocks that we're following. And a lot of times, American funds, other mutual fund companies don't change their top holdings. That's a very good indication that these are good stocks to buy and hold for a long term. And you can see by their portfolio weight how much they believe in that stock. You can see right now NVIDIA is their top holding. Microsoft, Meta, Broadcom, Amazon, Tesla, Eli Lilly, Netflix, and Alphabet. Actually, Alphabet is their largest holding because if you add up their A and C shares, that is right at the top with NVIDIA. So a lot of times when I do my research, I use this as an idea generator. So if this fund has Eli Lilly as a top holding, there might be some credence in adding that to a long-term position in your portfolio. Um, Okay. I hope you enjoyed all this. I'm sorry for reviewing the basics if you've listened to me before, but every once in a while it's good to go over the basics and my theories so it all makes sense when I put it together every week. Okay, well, I hope you have a good investing week ahead, and I'll see you next time. Okay, there's a couple more things I wanted to go through. First thing is how the compound growth calculator works. I made a spreadsheet, it's called Compound Growth Calculator, that basically allows you to put in variables where the highlighted amounts are, and it allows you to calculate how much compounding um, will come out to after over time. So let's say we start with 2026 as the year, and then we start at the age of 29. And you start with 100,000, let's say, and your contributions are 50,000 a year, and you have a growth rate of 15%. So at the end of the year, you're going to have 165. And you do the same thing with your retirement savings. So you have, let's start off with 43,000, you add 18,500 a year. And if it grows at 5%, then you'll end up at the end of the year with 63,000. The great thing about this spreadsheet is you can look 30, 40, 50 years down the line, and you can see if you continue this pattern of growing at 15%, adding 50,000 a year, you end up with 176 million dollars when you're 71 years old. So that's the power of this simple spreadsheet. I've used this same spreadsheet since 2008, and it worked out perfectly when I tried to do my calculations. Um, when I started in 2008, I started with a certain amount. I thought I would grow at 5% because that's what CDs were yielding at the time. I added 120,000, and come to now, it was almost exactly how much I have right now. So keep in mind this growth compound calculator. Next thing I'm going to show is that same calculation done with investments. So we track a bunch of stocks. We have two different yields, two different fields that we're keeping track of. Whenever you're investing, you could put in I own like maybe two shares of Google, and right now the yield of Google is around 1%, and its growth rate right now is around 15%. So if we go to the year 2026, the total value of two shares is, let's say, 557. But if it grows at 15%, the year 2027, it's going to be worth 645, etc. And this calculates for every one of your holdings. So at the end of the year, if you have one share of each of these, let's say, that's a total value of 11,000. And if they're growing at the growth rates that we're predicting, then the total value of your portfolio is going to be this much and this much over 2029, for instance. And this is a micromanaged way of keeping track of your portfolio if you're in need of a certain amount of money for a certain purchase in the future. So let's go out into the future here to 2036. If we have one share of every one of these items in our portfolio, we'll have $348,000 in 10 years. So that's the power of this spreadsheet. I send the spreadsheet out every week. Um, so you have that. The other thing I wanted to go over was the difference between Roth and 401k, calculating that over time and how it works. What I'm going to do is I'm going to take an example. Let's say you have a starting investment of 400,000, and let's say we have a $530,000 amount And we're going to either convert it to a Roth investment. This is the Roth side. This is the regular side. No, this is the Roth side over here. This is the regular 401k. So I've marked Roth. This is 401k. Whenever you convert money to a Roth, you have to pay capital gains tax, or not capitals, but you have to pay regular taxes, like if it's the job, the income from a job. You got to pay that amount of tax. So in this example, we have a starting investment of 530. You pay your taxes on that to convert it to a Roth, and then you start with 402,000. So you have to pay $130,000 in taxes to do that conversion. Where over here, we start with 530. And let's say we grow at the same 15% return. You can see that the 401k is going to do well because it didn't have to pay the tax. It isn't until it isn't until 10 years where 15 years, no, where is it? It isn't until you start paying your minimum distributions when you're 72 years old where things really um, start going for towards the Roth as a better investment. You can see that right here, whenever you're 78, you're taking minimum distributions out according to a certain tax table by the government. And for every amount that you take out, you have to pay a certain amount of tax on those earnings if you have a 401k. But for a Roth, you can see that you don't have to take any money out for minimum distributions. And on top of that, you can let it grow. And whenever you take money out, you can you don't have to pay taxes on it. So that is how the Roth and the 401k compare over time. But you can see that you're forced to take out minimum distributions. And eventually, if you go long enough, you'll see that the Roth, the amount that you keep, and you're not forced to take money out, that amount turns out to be quite a bit more than the 401k. The reason why the 401k is kind of tricky, you start with 530, and what the government does is they have tax tables where you have to take out minimum distributions so that when you're at a peak age, such as 96, you should have zero money left in your account. Whereas if you had a Roth account, when you're 96, you'll have, let's look, when you're 96, you'll have 3 million, no, 3 billion instead of the having zero that the government wants you to have. But the that's the Roth IRA. But anyway, that's the extra things that I wanted to go over. Hope you enjoyed that, and I'll see you next time.